pleasure to be here today. I want to thank the FENG, and which I've been a member for many years, proud member, for sponsoring this event, and for and also, of course, to Christy for helping to pull it together, and Mark, of course, for handling all the coordination. I am a CPA. I have my MBA from the University of Chicago. I've been a practicing accountant for a long time, 30 years, almost 30 years. And Adele and I were joking a little earlier about age. And so she's writing the 30 number down. I could see her moving on her notepad. Yeah, I would say over the last, say, 4 to 5 years, I've been focusing heavily on mergers and acquisitions work. And of course, that has dovetailed nicely into SPACs. So I've represented both SPACs and target companies in all processes and life phases of a SPAC organization. And I'm really bringing the hardcore accounting perspective to today's conversation. Milos?
Thank you. Thank you, Mark, for organizing all of this. Thank you to Financial Executive Networking Group to helping us to speak on SPACs, and helping Mark again to sponsoring me and inviting me to join the group. My name is Milos Vulonovic. I'm coming from the EDEC Business School, where I'm Associate Professor of Finance. My interest in SPACs started in 2005. I was a graduate student at the City University of New York, and my mentor was asking me to think about a PhD thesis, and he said the best would be to do something that no one else is doing. So I spent a few months around, and I figured out no one is writing about SPACs. So I started assembling the data base from mostly on SPACs from 2003, this second wave, or depends how they label it, but what became the SPAC market with this Millstream acquisition corporation in August 2003. And then I started writing about SPACs. I started widening my database, going to the conferences in New York that Deal Flow was organizing, Douglas Elino, for various players in the SPAC market, and little by little end up writing a lot. In the last few years with Daniela Di Alvia, who is also one of the academics in SPAC market, we started to consult a little bit, not much in the US markets, but we were trying to consult or advise few firms from Asia trying to go to the SPAC market in Italy. And I read about SPACs. I like to debate about SPACs. My views are mostly academic, less maybe a practitioner, but I'm happy to be denied of at the time correcting anything that I'm saying. So thank you, Mark, again for the opportunity, and thank you all the panelists.
Super. Daniel.
Thank you, Mark, for this opportunity, and thanks to everyone that has joined us in this conference. I'm Daniele D'Alvia, and I am Italian and British, and I am an academic in Queen Mary University of London, where I am also an associate at the Institute of Advanced Legal Studies in London, studying SPACs for more than 10 years. I won a prize in the US by the American Society of Comparative Law back in 2017. So when SPACs were not yet the mainstream product of Wall Street. And then everything changed, as you know, from 2020, 2021. And during that years, I also had the opportunity to finish a book on SPACs that will be published then in November 2021 by Routledge. And that book is one of the first books that speaks on SPACs from a comparative law point of view. So, as you know, today, we see SPACs not only in the US, but all over the place. So in Asia, in the UK, we have a SPAC reform very interesting that is coming now into place on the 10th of August. So I think that the SPACs are becoming a mainstream product not only in Wall Street, but worldwide. And so it's very important, this conference, I think, and the future perspective that we can see in this kind of American innovation. Is what I think is this. I mean, in one line, I think is a very great American innovation and should be preserved in the future. Thank you.
Excellent, perfect. And Mr. Dell.
Hi, my name is Adele Hogan. I'm co-head of corporate and securities at Lukowski Brookman, which is a law firm, but I have done SPACs for long periods of time. And mostly I'm encouraging people to reach out to me because I'm very active in this area and I'm happy to help any FANG member in any way I can, whether it's being a board member, getting accounting positions at newly formed SPACs, et cetera. So hopefully we can work together.
Excellent, thank you. And last but not least, Christy.
Thanks, Mark, and thanks to FANG for sponsoring this event. My name is Christy Marvin. I'm the founder of SPAC Insider, where we provide data and analysis covering the SPAC asset class.
Excellent, perfect. And I'd just like to add that the comments today are the opinions of the panelists and not necessarily those of their firms / universities. And so once again, please add your information in the chat. Let us know where you are. And then also, if you have questions, feel free to politely interrupt so that we can have a nice, engaging conversation. And so I'll start off with, there's been a shift towards SPACs, obviously, these past couple of years. How do you think that Chamath, I can't say his last name, Chamath's Virgin Galactic deal helps further sudden trend? And do you think it's the beginning or the peak? And I guess, Christy, you can start off and then.
Yeah, so the Virgin Galactic deal was probably the first SPAC that actually got a lot of media attention, and it certainly got a lot of people talking about the SPAC product. Until then, in nearly every single article, it was no one really knew what a SPAC was, and usually every article started with a so-called blank check company. And so that certainly got people talking about what a SPAC is. However, I actually think DraftKings is probably the deal that put SPACs a little bit more on the map, and particularly because it was like right around COVID, and it was an extremely successful deal. Not that Virgin Galactic wasn't. It's just it just caught the public's attention, and I think it also caught retail's attention, which sort of played into how the rest of the year went.
Excellent. Adele, do you want to chime in on that?
Yeah, first of all, it's a thrill to have Christy here. She's like a total rock star in our world.
I'll let someone else chime in. Maybe it's
huge on data. But I think also the Pershing Square deal was very important in this market. Just because it was so huge. It was just a huge deal.
It was a huge deal. Yes, it's super. And so what do you think are the main differences between the US SPAC market and the international SPAC market? And Milos, if you want to start us off there.
I can tell you based a little bit on my research and a little bit on our consulting. If you think about the US markets, we all know, we are following, and more or less Christy and Hogan are much more equipped to speak about it. I can speak about European markets mostly. Danielle and me participated a little bit in Italian markets. It's a good experience for me. I knew that Italian market is kind of two-tiered market, and the SPACs are listing on something which is kind of similar to the OTC. So more or less, it's a kind of deal done by market makers. You arrange for these market makers do a roadshow, they arrange for capital, and then they go through the SPAC process. We were advising. It's in the public, so we can say we were advising one fintech firm from Malaysia, and in the process, when we were kind of trying to collect the capital, my feeling is that these Italian underwriters wanted the deal to happen in Italy, so they had capital for you, but they also had a target for you. And me coming from academia, I was feeling this is kind of little bit odd and maybe not according to the practices in the United States. So that's kind of my experience from Italian market. So I would say market makers are controlling it. And if they raise money, they most likely want you to kind of agree with them what the target is going to be. So it's not that free market like in the United States. France is a little bit developing the market. There are like few major deals over there, but in France, they really kind of get very high profile people. Everyone knows them in the France. They are one of the most well-known executives. And in addition to the structure, they put a lot of their own money. So the few SPACs in France work. Netherlands is relatively close in structure to the US, probably the closest one. And before the last week, the UK was in essence lagging, but there were like some changes in the way how the SPAC would be traded after the potential merger announcement, although we didn't see it being in the place still, but there will be changes. So to sum up, the SPAC market in Europe compared to the United States is really kind of in development phase. I would call it non-competitive. Maybe Amsterdam is probably in terms of the rules the closest to the United States, but the pool of the capital is not that big. In the places where the pool of capital is bigger, maybe Milano and this OTC, it's kind of still not structurally close to the SPACs in the US, and London hopefully now picks up the game and brings itself close to the US approach in the SPACs.
Yeah, I'll just sort of tag on that, what Milo said.
Yeah.
You know, everything I've heard from people, just because I'm personally trying to get up to speed on the European SPACs as well, is that it's a very different capital raising experience over there and far more difficult, particularly on the back end with pipes. And so there is a certain amount of excitement for European SPACs. I think it's probably being generated by the bankers who are looking for another avenue to list. But everyone I've talked to says it's just a completely different market. Very hard to raise capital, very hard to get any investors over there to invest in a SPAC. However, as we've seen in the US market, that can change pretty quickly. So, you know, the recent listing changes for the UK listed SPACs certainly opens up a new path for that. Just remains to be seen how educated the investors are over there and what their appetite is.
So, and just remember, even though I'm a US lawyer, I do a lot with Cayman Islands and offshore activities. So whenever we're setting up a SPAC, we're deciding, do we want to have a US SPAC or an offshore SPAC? And then there's certain legal and accounting rules that go with that. And
So-
it may depend on where your target is.
So forgive me, maybe this is a naive, simple question. Can you articulate the differences between a US SPAC and a foreign and why you do one or the other?
Yes, I mean, there's tax reasons, but you're not allowed to structure just for tax
Of
reasons.
course not.
And also, we look at target. If our targets are going to be offshore, there's probably no reason to be onshore. And then the third factor is, what is your management, your sponsors and board of directors, et cetera, because in order to be genuinely offshore, it's not just incorporate there, but you have to have senior
Offshore management.
Yeah.
Gotcha. Thank you so much, Adele.
Yep.
Danielle, oh, okay, perfect. Chris, you wanna add to that?
I wasn't going to add to that, but I can, and just leave a tease out there to say that the accounting is much more complex once there's a foreign SPAC. So just something to be aware of. I won't go into it because it's a lot, but just to let you know, look, if you're thinking about forming a foreign SPAC, it's going to take some heavy lifting.
That's helpful. Good to know that it's out there, and if needed, can be looked into more.
Yep.
Superb. Yeah, I mean, Chris, we don't mind if you touch on a couple of the things. You know, we do have some finance folks. Well, everyone in the room is finance folks. If you can enlighten us a little bit on some of the differences technically.
On the technical accounting differences between European and well, foreign and domestic US SPACs. Honestly, I don't know a ton about that subject matter, so I'll be very honest with you. Everything I've been working on has been domestic. We had a London-based SPAC client that we started to go down the path with, and they ended up pulling up and not forming because of partially the accounting and partially the regulatory issues.
Super. Danielle, what are your thoughts?
Yeah, maybe what I would like to say, one of the main differences that is between US SPAC and European SPACs is that, as you know, in the US, you have a founder warrants. So the sponsor is going to put capital risk on the warrants. And this is not the same in Europe, especially in Italy. In Italy and also in other countries in Europe, we have this possibility to have preference shares. So we just have a sponsor that, as usually, these preference shares are given to the sponsor for free. So they don't really put capital risk, but they, of course, pay the running cost of the SPAC, pay upfront the fees of the underwriter, little bit like in the US, but not the warrants. The warrants, founder warrants for the sponsor are not always there. It's just a selection of the sponsor if they want to have that or not. And so usually this means also that if the SPAC is liquidated, if you have preference shares, you are preferred to be liquidated. And so in reality, you are not really risking a lot of money on the side of the sponsor. So this is something a little bit different. One thing that we saw that is similar for sure is the quality of the sponsors. So for example, Virgin Galactic, DraftKings, and all the other SPACs that we saw then in Q, the quality of the sponsor is very big now. So even not only the quality of the sponsor, but also the fact that the underwriters that are involved are very important investment banks. This was not 10 years ago or 5 years ago in the SPAC market. And the same quality is in Italy, is in Europe. We have Jan Osborne, that is a British businessman, and he just sponsored a SPAC in Euronext Amsterdam for 400 million. So Amsterdam is becoming for sure a SPAC hub, very important. And what we have seen, especially now in Europe with the European Security and Markets Authority, is that we like harmonization, but we don't want like a regulation, a directive that impose a SPAC framework for every country. We want that every country and every regulator is free to regulate SPACs as they prefer. But the European Markets Authority has issued a public statement where actually they started to highlight some features that should be there in the regulation, like the disclosure on the side of the sponsor, that they can have conflict of interest. So little bit modeling this on the US model after the Security and Exchange Commission. I mean,
Corbett, you have a question?
Yeah, I had a quick question. Whilst we're talking about international markets, the question I had was, what is the attractiveness of going through a SPAC process in the international markets when, the US market is flush with liquidity? Why wouldn't you go through this process? It's pretty much well understood for a company that wants to go public through SPAC. Isn't it a better option to go through the market here than try and do something in the UK or Italy where it's still kind of early days for them, to be honest?
I think it's a regulatory arbitrage. So the fact that I can take advantage of the regulation, of the lack sometimes of regulation. So this is the fact that now, for example, in the US, there is a big focus on regulation. And in fact, we hope that this focus, will not be so high, because otherwise many sponsors will look at Europe that is more flexible. In fact, the European Stability Markets Authority was smart in this. Didn't say that we want regulation like in the US, we want to be free. And that is one of the main things, because SPACs are informed by self-regulation. And that is a little bit strange in the US, because actually the Security and Exchange Commission was the first one to implement this kind of self-regulation. And now a little bit they are going on the other side.
That's interesting. Thank you. That's helpful.
Can I actually pipe in with a no pun intended? No pun intended. Pipes, but I think Danielle mentioned the United States and the regulators. I just wondered what your thoughts were, given that we've had a few fairly high-profile snafus in the SPAC frenzy here, Nicola included. How you think the regulators will look at it, and how regulation will actually involve in the SPAC market, whether that will make it maybe a less attractive investment category over time?
I mean, that still has to be seen because we have to see how the regulation will develop. But for sure, I think the SPACs, they are informed by self-regulation. So in any case, especially in New York, for example, if you think the New York Stock Exchange, NASDAQ, we have listing requirements. What maybe was missing are all the disclosure requirements on the sponsor. So if there is a conflict of interest, what you cannot really control is the uncertainty. So regulators, they want to control uncertainty. And this is something that I say also in the book. But this is something that you cannot really regulate. How you can regulate something that you don't know what is the outcome? What you can regulate are the conducts of people. So the fact that, for example, if there is a conflict of interest, I can disclose it. Or for example, if I make some promises to investors, I will try to keep them. Although, of course, as I think Milos can even tell every time, there are two moments, the SPAC IPO and then the de-SPAC. So the de-SPAC is the moment where we say always the target has to be ready to be public. So it's not the fault of the SPAC. In case it's the fault of the target. So, I mean, I think there is a lot of misconception. This is what I see sometimes. Misconception in the market because it's new. That is what I think.
Excellent. Thank you. And folks, feel free to unmute yourselves and politely ask questions to our panel. We want you to take advantage of having everyone here. We don't want this to be like other Zoom casts where it's just the speaker speaking. We want it to be, like I said, a relaxed fireside conversation. So what are your thoughts regarding the correlation between inflation and SPAC activity?
Should we pick up or fight who is going to go first, or
Milos?
Yeah, I'll get the first and then please correct me. I think the inflation, we see inflation now in numbers. When I was PhD student and when I'm teaching in the classroom, they always taught us if the central bank is printing money, expanding monetary base, M1, M2, and velocity of the money is kind of constant, there will be inflation. If you didn't answer this, you would kind of fail on the exam. Then there was a story about liquidity trap, or this money is going to the asset markets, and that's why we have record Dow Jones or something similar. But we have substitution of the imports from China and many other reasons, so there was no inflation. But economic indicators for the last month said there is inflation in the United States. And given that the money in the trust account is kept and earning T-bill rate, now this wedge between T-bill rate and inflation or real return to SPAC investors holding money in the trust is negative. And it could be, let's say, if obviously they can trade it in the market, but this money could be below the trust value, and it could be significantly. I wouldn't be surprised personally if maybe if not the main numbers, but if the numbers of the inflation would be like 7-8% for this year or the next year. It may not happen, it may be 2 or 3%, but these high kind of numbers of inflation may real return to the trust, SPAC trust negative. And this could upset some investors in the market, especially hedge funds. there is no reason in this inflationary, I would say, period of the United States, with plenty of the money to keep and lock your capital in the SPAC that is earning T-bill rate. So at the margin, this would diminish the demand for SPACs.
I have a different take.
Yeah.
I have a different take in that, you know, a lot of the time SPACs are sort of competing against PE. And as inflation rises, you know, that's difficult for PE to raise money, right? So you don't have to compete against them. The other thing too is the data point of, I think we talked about this previously, Milos, 2007, right? Which was prior to this whole new wave. 2007 stood as a record for like 13 years for the most number of SPACs raised, at 66 that year. And at the time, inflation was big, you know, and it didn't stop SPACs at all. And so I also think, you know, interest rates too. I mean, interest rates are close to zero right now. I don't think that's, and it's been close to zero since COVID started, at least in the US. So I don't think that's going to be an issue. Like, you'll never have negative rates. Like, negative rates, SPACs would just, they would have to guarantee at least $10 in trust. Like, it wouldn't be an issue.
Yeah, I would agree in trust, but let's say T-bill is earning 2%, inflation rate is, I get the number of 539. So it could be, but you may be correct. This is just like my.
Isn't the question slightly different though? Because when you think of inflation, you know, when you invest money into a SPAC, it's not for the purpose of remaining in the SPAC itself, right? The intent is to merge with another company, an operating company of some shape or form. So, you know, whoever the investor is in the SPAC is not necessarily thinking of the return on the cash. If they are, then they're probably doing the wrong thing, to be honest. I would have thought the bigger question is, like any new young company, as inflation is up, the return it takes a longer time, right? So the valuation goes down. As such, that may be a bigger consideration as opposed to, hey, what are we going to do with the cash in the SPAC itself for a temporary time period?
See,
it became an issue in the spring, you know, where people were sort of saying, well, maybe we should be looking at value companies, you know, like SPACs should be acquiring value companies as opposed to growth companies because of that issue. Yeah.
This is where you need an experienced team that can execute quickly and effectively, because people don't want to sit around for 2 years and then there's a scramble at the end. And actually, there's a recent SEC case where they did an enforcement action where a company was coming to the end of its 2-year life. The trust was, but you need to, I was doing a SPAC recently where the banker said, I want you to give me 18 targets that are viable. So I know that you guys know how to do due diligence and get going. And also you can't, of course, identify your target up front, but I don't want to hear about it in 18 months. I want you to be able to execute now. So the cash isn't really sitting there for the whole 2 years.
Yeah, may I just add a point to the two speakers before? In the last month of July, the redemption rates for some SPACs, I think the average redemption rate was 35%. That's my calculation roughly, but around 27, 28 SPACs. For these top 7, I think the redemption rates were over 75%. So these people were keeping kind of shares and they redeemed like now. So I probably they didn't make any money on this redemption these days. That's my feeling for the July.
Superb. And
well, I'm going to jump in here on this one only because we were sort of talking about this before everyone kind of got on the call too. The trading patterns have been sort of interesting for some of these SPACs going into votes. And as you know, or maybe you don't know, but you know, you can usually gauge how a vote is going to go, at least as far as the redemptions, based on where the share is trading relative to the cash and trust value. So if it's trading like significantly above 10, there should be no redemptions, right? Because why would you redeem? You could just sell it in the market for a far greater price. If it's trading at trust or below, like then you start to get pretty worried. But there was an interesting deal today, Peridot, symbol is PDAC. And that had been trading well above $12 only a few weeks ago, came down, was trading ahead of the vote below 10 in the $8 range, which is, you know, usually that means like you're going to have a disaster of a vote and everybody's going to redeem, and only 11% redeemed. And then as they announced the closing, it traded up and it closed up today almost 12%, which, you know, this has been happening sort of repeatedly. The other time it happened too was recently was with Course Holdings 5, which bought Ardagh Metal. Similar pattern. After they announced the vote, it traded up. And so the redemptions, Milos, you're right, there have been a number of deals that have had significant redemptions, but it's not across the board. And trying to read the tea leaves now is just getting far more difficult, because you have some of these deals that are trading below trust and you would expect to have heavy redemptions. They're not. And, you know, the thinking being that it's still a good deal, but maybe long only the natural buyer of these shares post vote, like they want to own the operating company long term, they're just waiting for the vote to, you know, they don't want the risk ahead of the vote. You know, why buy? Like, there's no motivation to actually buy ahead of a vote now.
True. Thank you.
Okay, excellent. Anyone else want to add to that?
I have a question. In terms of performance of the, you know, particularly de-SPACs, what proportion would you say of the de-SPACs that we've seen in the last couple of years have actually made positive returns for our shareholders?
It depends on what year you're looking at.
So let's say relative to the IPO price of a SPAC, which is, you know, maybe the benchmark. How many are actually trading well above the $10?
Yeah, so this gets super complicated, and so many people have tried to do this analysis, but here's why it gets complicated. Because in the return, you have to factor in the warrants, you have to factor in maybe some rights, you have to you know, take into consideration at what point in time, right? Because not every SPAC de-SPACs at the same time. So if you're trying to do an analysis of, let's call it 2020 SPACs, some of them are still searching, some of them are announced, some of them haven't de-SPACed. Where do you measure that? And then do you calculate the return based on all the components of the actual unit? A lot of people, like particularly people in the news, like what they'll do is they'll try to measure it based on just the share price, right? But that's not really accurate either, because if you're an investor, you could have bought a unit at $10, you could have peeled off the share, sold it, right? When it maybe traded, like you just didn't want it, right? You held the warrant. You know, and so like, but everybody trades it differently. There could be somebody else who peeled off the warrant and sold it, right? And just held on to the share instead. So how do you measure return? It just gets really complicated. If you do want to measure it just by the actual share price, even that gets tricky too, because like if you're an IPO investor, and let's say, so you bought the unit at 10, right? But we're just looking at the share. If you redeem it at, let's call it 10.10, you made 10 cents, but that's like not meaningful. But let's say the deal was an absolute disaster and it traded down to $5 post vote. You still made money, right? And so like the shareholder wasn't hurt. So how do you judge it, right? Are we going to judge it by return? Are we going to judge it just by like where the company is priced? That's why it's like, it's a very difficult answer.
But does that make the investment category then less attractive because people are not able to determine the return? I mean, when you do some research, you know, people will look at the share price of a de-SPAC, for example, and if it's below $10, then it's for them they'll consider it as a poor investment.
Well, so then again, there's different types of investors, and here's where it gets weird too, right? Because you have the IPO investor, which may be an ARB, right? And he's just ARBing it. If you're talking about a fundamental investor who is buying the operating company ahead of the de-SPAC, that's a different story. That's a fair argument to be able to make a decision as far as a return. But again, like where do you measure where they bought it? Did they buy it ahead of the vote, right? You have to like mark a date and time, I suppose. I will say, the guys, Michael Alrogi, and I forget the other gentleman's name. I want to say Klausner from Stanford. They did that.
Klausner.
Yeah, in 2019. And they did like, and they struggled with trying to wrangle the analysis. And that was a good report. But It was 2019, and 2019 SPAC market was significantly different than 2020. I've talked to them. I'm trying to get them to update that, but they don't want to because it's just such a nightmare. Yeah, it would be interesting for sure. Yeah, I do think personally, without having a number for you, that the results for 2020 would be significantly better.
Yeah. I would just to agree with Christian. I would add, for some reason, and maybe these two guys, Aldrich and Klausner, because they are very famous in a law professor somehow, I think they put bad stigma. And I was trying to argue on every forum and in exchange with them, it's not the job of law professors to calculate returns on SPACs, because probably they didn't collect warrants data, and they are very murky how they calculated this return on warrants. And if we think about, as Christy said, the question is returns for whom? Is this IPO investor who is investing in SPAC? And when is the exit date? If you are IPO investor and if you want to keep it until the merger and acquisition, you cannot lose money. It's completely risk-free. And then you can keep a warrant. But now the question is, at what point you execute your warrant? If you execute it at the maximum price that could be happening one day, maybe these returns are very positive. So it's really kind of hard to calculate it. But many people in the press and in the important outlets, Financial Times, Wall Street, Bloomberg, around, Klausner, they ignore warrants. But warrants are a really big part of the SPAC issuance. They're just like, maybe now they are 1/3 of a share or something like this, but they're big. So we cannot calculate returns without fully understanding the warrants.
That's definitely from a person who invests in the SPAC before it de-SPACs. But I guess people are focusing on the de-SPACs, and those are the ones that are really have, a lot of them are bombed out, I think. That's
But if you think about de-SPAC, maybe few of these initial SPAC sponsors stay with the de-SPAC. De-SPAC is a new company whose valuation is discovered in the markets. That's the first time they go to the market. So it could be good company or bad company. But again, we need to account all securities. Okay. Thank you. Sorry.
Thank you.
Super. Thank you for that question. And once again, folks, don't just let the gentleman ask all the questions. If you guys have any questions, please feel free to politely unmute yourself and show your face on the camera and ask questions. So how quickly after the SPAC issuances go down do you expect a correction in the private markets? And anyone from the panel can take that question. Adele? You're on mute, man.
I'm not, I just want to make a comment, is maybe not directly on that question, but basically to say, the SPAC market has also helped a lot of underperforming companies. Sort of Lukowski Brookman is, I think, #1 in these uplisting deals where they take NASDAQ companies or companies that are sort of fallen angels, but they still are SEC reporters. And they uplist by doing an offering and then do a merger. And they are competing with SPACs because they don't have a 20% takeaway, which is like a private equity type setup of a SPAC deal. So that's why you're seeing this huge activity in this market as well. So I think all of this activity is very good for investors and offering a lot more choice. And remember, we lost like half the public companies at one point because there was a huge amount of going private and things like that. So this is a chance for people to get back into the markets, and there's a lot of investment money that needs to be deployed. And it gives a chance for people to get these private equity type returns without being in the private equity space.
Thank you, Adele. What about, and then if you can't answer this because you can't discuss your portfolio companies, what ways are you helping your portfolio companies navigate the SPAC sponsor universe? Or your clients, should I say?
on this, the SPAC sponsor universe, I mean, I'll just say a sentence or two. We help companies set this up, and it's crazy. That's why I'm encouraging all the FANG members to get involved here, and I'm happy to help them. But you literally are on conference calls like, okay, who wants to be CFO? Oh God, we need a president. Who can we get? It's a very, very fast-paced, hectic process, and but with very sophisticated people, and it's a very math-heavy area. So the lawyers that practice in this area tend to be very good at math, because as Christy was explaining and was being explained by the other panelists, just doing all the math in this is very complicated, which is perfect for this group.
It is actually superb. And so can you maybe, Christy, explain or anyone from the panel, the roles of the different entities involved in the SPAC, from M&A underwriter, attorney, auditor, and possibly the third party support, valuation firm or accounting support?
Sure. So are you talking about on the D-SPAC? I didn't quite catch the first part. Yeah, the D-SPAC. So
Yes.
Obviously you have some sell-side advisors. You're going to have some buy-side advisors. Occasionally you have, what they call capital markets advisors, which is more often than not the underwriter on the IPO, right? And they're helping market the transaction, because all really the D-SPAC is like a re-IPO, right? It's an M&A transaction, but you still do a dog and pony roadshow to meet with investors ahead of going public. Then obviously you have your legal advisors, both buy and sell side. Can't emphasize this enough. Get a good IR firm. You definitely need it. Probably the most underutilized service provider in the D-SPAC transaction. Who else am I forgetting? Well, obviously the auditors, right? And maybe Chris, maybe you can chime in, because a lot of the time they'll bring on a new auditor, right?
Yeah, that's fairly common. So, from the portfolio company's perspective, at least, a lot of times the company that got you there doesn't have the sort of the SEC reporting chops that are necessary. So you will need to look at other firms. The one thing I'm just speaking from my own personal painful experience here, is I highly, highly recommend that everybody engage with a valuation firm early on, and find somebody that's good and get on their calendars early, because these guys are busy, and women, right? So all these valuation firms are scrambling right now. There's a lot of transactions activity happening, obviously, in the SPAC market, and they have multiple other uses. They're valuing goodwill for corporations and things like that. So they are busy.
What would you say is early?
Sorry.
Go ahead, Erin.
Go ahead.
Thank you. Thanks, Mark. So Chris, on the valuation point, that's a really good topic, and something I did have a question. Would you use, or would you always recommend using a valuation specific firm, or would you recommend working with your investment bankers and utilizing their expertise? Are there any thoughts, one or the other, pros, cons on either approach?
That's a great question. I don't know, Christy, do you have a thought?
Yeah. I was just going to say, so here is where it gets interesting, right? Yeah. So in the past, if you look at some of these transactions, sometimes the underwriter will represent both sides of the deal, which is a little strange, right? Well, but so like they'll raise a pipe, but they're also representing the sell side or the buy side, or something like that. And it gets a little funky. And so 100% in those situations, you absolutely need a
separate. You need independence on that point, sure.
Right.
But if you did have two separate investment bankers representing either side, is there a view on using the valuation expertise of the investment bankers? I mean, given that they are in the market and they are seeing what's going on, I would think they could also bring a unique experience and perspective to the topic that potentially a valuation firm might be slightly removed from.
Well, I personally think there's, getting a fairness opinion, not necessarily having to bring on an expert valuation firm as a financial advisor, but just getting a fairness opinion is generally, it's pretty economical. you know, and I think it's smart,
use your auditors
especially in
for
the
that
current
too,
regulatory
couldn't you?
environment, like to just dot your I's and cross the T's, you know?
You could use your auditing, your accounting firm for that, for just a pure fairness
Right,
perspective.
right.
Okay.
The only thing I might add to that is probably have a blunt conversation. If you have an audit firm and you're talking with the partner, ask them, right? Who do you work with well?
Yeah.
Now, you don't want to be seen as trying to like, roll the, spin for the right audit opinion, right? You're not trying to get an
No,
audit opinion, but if your valuation firm and your audit firm have a good relationship, then the audit firm doesn't have to go through their whole evaluation processes. Like, are these guys good? Do they know what they're talking about?
sure.
Do they have the credentials and things like that? Adele, you're muted.
I know people know this, but the audit firm can't also do the fairness opinion, and an audit firm can, but you have to have independence. So, and there's also some excellent SPAC advisors in this market that help walk companies through this. So if you need that, we have excellent, I think, very economical and very experienced people that can help.
Yeah, so thank you, Adele. That's a great point as well.
So your
So,
auditor can't give the fairness opinion? It would have to be a separate firm?
separate firm.
Okay, good. That's good to know. Thank you.
So my firm in this space, we do a little bit of external auditor, independent audit performance on SPACs and portfolio companies. But the majority of the work that we do in the SPAC space specifically is staying on the side of management and representing them from a technical accounting perspective, particularly for the targets. So you think a lot of these targets are generally relatively small companies. They're bootstrapping themselves up. I don't want to say they've cut corners, but they haven't made the proper investments in accounting and finance and IT and infrastructure that you might normally see because they're growing so fast, right? And then they're just trying to hit revenue numbers, and all of a sudden they get interest from a SPAC, and they just don't have the internal infrastructure to pull together SEC filings and to go through SOX controls and all that sort of thing. So that's where my firm steps in. We also have a valuation arm, and we can do that no problem for a company because we're not their independent auditor.
Got it.
That makes sense, yeah.
Yeah, it does.
Hey,
Thank
Chris.
you. Thank you, Adele. And Christy.
Hey, Chris and Adele. I know we talked about the external partners that you have to identify and kind of work through, but you kind of touched on the internal, when you have a company that's kind of growing really fast, that they may not have the infrastructure in place. Now, when you de-SPAC, you're effectively a public company, and there's a whole bunch of requirements that they may not appreciate upfront. What's your view on that from that perspective?
Well, that's why I have to
Let's talk about that early.
That's why I congratulate Mark for picking this topic and doing it. This is SPAC number 2, because this group is exactly what is needed. You need experienced, people that know how to do public company reporting that can step right in. So people from the FANG would be ideal CFOs or ideal board members and other kinds of strategic officers to help companies get through this.
Yeah. And are you finding that they're receptive because it's a mindset shift, right? They've been used to operating in a private environment and maybe not recognizing the fact that, hey, it takes a whole bunch of different skill sets to be a public organization.
Oh, the bankers won't underwrite people that don't have some experienced team members. This is not for kids, like there are definitely people, you might be young, but you've got some experience behind you. Right. And the banks won't underwrite you, and the investors won't invest. I mean, they look at the bios and they want some experienced, seasoned people in that team.
Some adults in the room.
And I think, it's really there, the real challenge that is even today is on the SPAC. So it's on the fact that this target company in general must be ready already to be public. So for example, if you are a lawyer, you are advising the SPAC. In the end, once the sponsor is approaching the target, at that point, you need to be sure as the sponsor, at least, in reality, it's not really your job as a sponsor, although yes, some people, they say it's your job to find the right target because you take the SPAC bonanza. So in reality, you are taking the promote then, so you are taking further money. But it's also true that the sponsor is betting a lot of money in the SPAC. So in the end, they want to make things in a right way.
Yeah.
The only fact is that on the other end, it's always a sort that is a typical M&A activity. So the fact is that on the other end, you have a target. The target may be a promising company or a zero revenue company. They don't have any revenue today, but they start to promise people that they are the next Tesla, for example. That is something that, I mean, who is the fault there? Is the fault of the sponsor that believed that, I mean, that is the next Tesla, or is the fault of the target that they want to become public and they want to become immediately and very quick and 10 billion company? So in the end, I mean, I think the best lawyer wins. So the fact that if you know how to structure this operation, if you are, I don't know, White & Case is very good form on this SPAC. So like they can act for a target company and they can make a good deal for them. But they can also act very good for the sponsor. Depends, have two different kind of views. That is the point. So it depends where as a professional you are, who you are going to advise. Because the sponsor wants to just go out from the transaction in some way and then give everything on the target. That is there.
So maybe a question back to Adele and the point that she's raised a couple of times about this is a great space for members of the FANG to get involved in with the SPACs and maybe being the adult in the room and having a bit of experience. It's something that I've looked into, but where I always run into a bit of a challenge is, at least traditionally and to date, many of the companies that are going through this process prefer a CFO who's done it before. And it sort of becomes a little bit like a catch-22. You can't say you've done it until you've done it, but until you get that first one, you're sort of a little bit challenged. Do you or any of the other members or speakers have any suggestions how to break into that space that we might be able to utilize?
Well, one way is to get known at banks, the banks that are big in SPACs, because they're always looking for, oh God, I need an extra board member, or California has 3 women requirement. I've got 1, I need 2 women really quickly, or I need somebody who has risk and governance expertise in addition to financial, who can do that. So just get known, come to these things, get known, go to conferences and things like that, try to make friends, because it's really catch as catch can often in the beginning.
Thank you.
Excellent. And Erin, if you could briefly just tell folks 1 or 2 sentences your background.
I'm sorry, Mark, I didn't quite fully hear what you said.
Your background, former, just a couple sentences, just so
Sure.
they know.
Thank you. I was most recently with Allianz Global Investors as their US CFO, building their first finance practice in the US and then also part of the global team. Before that, I was there about 7 years. Before that, I was with Deutsche Bank for a dozen years in a variety of line and project roles, both CFO and global projects. Before Deutsche, I was at D.E. Shaw for 4 years. Joined them right after this guy left the company to start a book company called Amazon. Stayed there through a big growth and then a big downsizing. And before that, I was in public accounting.
Perfect.
And if
Excellent.
I
Yeah,
stretch
just
back a little bit earlier, I was actually in the legal field. I was a paralegal, and that's how I put myself through college full time at night.
superb. And I shared Erin's information in the chat. Thank you for your questions. And I agree with you, Adele, regarding FANG members being good board members, etc. For SPACs. And so, folks, please do share your information in the chat. Reach out to Chris, reach out to Adele, and then obviously, network with Christy and the other panelists, because these are the folks that this is the thing. Remember that. So I'm just kind of want to make sure that you guys are networking and you're not allowing COVID to stop you from connecting with folks. So also look through the participants in the audience as well on the side and reach out to people and connect with them offline on LinkedIn. We sometimes can forget that as well. So I know I do sometimes. So anyways, with regard to the sponsors, what makes them trustworthy to, or seem trustworthy to investors? And if we can go to Milos for that. You're on mute. Milos, you're on mute.
It seems that previous personal experience and connections in the kind of mergers and acquisition worlds count the most. That's academic kind of finding. So if you were a serial sponsor before, most likely you established the ecosystem that can deliver a new SPAC. And in addition, these successful people, let's say you do successfully one SPAC, second SPAC, third SPAC. My personal calculation, and this is again hard to get returns, but my personal calculation is that around $1.7, the usual stock price of SPAC is around 10. So if you kind of manage to have 1.7 post merger, you're positive as a SPAC sponsor. So these SPAC sponsors realize positive returns with 1 and 2. And I guess they have better ecosystem, they know the game, they know how to pick the target, and they are more willing to forfeit shares or warrants or something in the deal, or take a little bit more for the next deal to be done. So it seems that it's previous experience and obviously experience, especially in this harder market. And I guess this would be the true for this year and the next year.
Excellent. Christy,
Yes.
what makes the sponsors seem trustworthy to investors?
Yeah, I mean, as Mila said, SPAC experience counts, right? And if someone has a track record you could point to, the same way you kind of evaluate, someone running a fund, right? Like, do they have something they can point to and show success? But further to that, we've had a lot of new teams this year. It's all about their CV. Have they done deals before? Have they done deals in the space they're intending to focus their search on? Do they have the kind of connections and Rolodex that will enable a significant deal flow in, again, the target area they're looking? I personally have always thought that the best teams have been a combination of both an operator and a deal maker, right? And so the operator is going to have significant industry experience and contacts and will be able to evaluate a company, and the deal maker is going to be able to put the deal together. And in my mind, like, those are always the teams that are usually successful.
Superb. Chris.
Boy, that's a great question. I think it's relationship driven, just to kind of build a little bit on what Christy has just said. It's people trust the people that they know and trust. And I think that's kind of what I've seen happening. I've seen a couple of deals go down with executives that I just shake my head and think, these people don't know anything about running a business, but they do know the sponsors. And so that's what's got the deal done. And, they've been successful. I'm not saying that's the wrong way to go about doing this, but that's what I would say. It's all relationship driven, or largely relationship driven.
Excellent. And Adele, are you seeing the same thing, basically?
A lot of times you see these big ticket people sometimes as a draw, including sports people and, people like that. But you see these serial SPAC people, they're really doing a good job.
Excellent, thanks. And this is a question from the audience. Alex, if you do want to unmute yourself and show yourself on the camera so that please feel free to do that. What we're trying to do is engage, break the back of COVID and network. This is the thing, Financial Executives Networking Group. So if you want, I can ask you a question for you though.
No, that's fine. Thanks. So Alex Booth, I just recently got appointed to be CFO and secretary for a SPAC, I guess, information. And obviously one of the hot button issues that we are dealing with is this SEC statement on the treatment of warrants either as equity or liability, right? And really, I think in a nutshell, the issue was that if you had separate classes of warrants, some with restrictions which depend on the holder, you would be forced into the liability treatment. And in order to get around that, I guess a lot of the folks are just eliminating all of the restrictions that were typically placed on the founder and working capital warrants, but in a way that made the deal more difficult or less attractive to the public warrant holders and public stockholders. But maybe I'm missing something. If anybody has any thoughts on that.
So I'm a lawyer, but I do a lot in the capital market space, obviously, and the M&A. So a lot of the times it turns out whether it's convertible to cash. Is it convertible or exchangeable into cash? And that's what triggers it into debt as opposed to a liability. But I know our partner from Crow can address this more carefully, and it's really very fact specific. So you have to look at each deal and each instrument in the deal.
Thanks, Adele. You've set me up perfectly, right? So
before you get there, Chris, like really quickly, I will say that the vast majority of SPACs this year have had fractions of warrants, right? And so you're talking about deals with a quarter warrant, a fifth of a warrant, an eighth of a warrant. And so it's not as meaningful. I mean, it's certainly meaningful for the deals that have a full warrant, but anyway, Chris, I just felt like
one other thing on that. I've looked at some of these restatements or been involved in them, and we're talking like de minimis amounts. It's the same point that Christy's making. It's like this: companies are getting off track in their 34 Act reporting for some tiny little amount. It's kind of too bad.
So yeah, so let me couch everything I'm about to say with this caveat that these are my opinions only and not those of Crow, because we do a lot of SEC work, right? I think the fundamental challenge here, Alex, is there's a disconnect. So as you sit there and you look at, Adele's going to nod and Chris is going to nod when I say this. When you look at the economics of the transaction, putting warrants into equity makes sense, right? Because they're an equity instrument. They're going to eventually become equity. So I think that makes sense from kind of just an economy perspective, right? Or the essence of the transaction. When you dig into the accounting though, who has the, as Adele said, if it's convertible to cash or not makes a difference. Who has that capability to trigger the conversion? Is it redeemable or is it exercisable? Other things to think about, right? And I'm not going to give you any specific guidance under the advice of Crow's in-house legal counsel. But what I will tell you is that you have to look at debt versus equity, whether that's permanent equity or temporary equity, all right? So a lot of these warrants actually need to be classified as temp equity, or mezzanine equity is what we used to call back at school, if you remember, Alex. And then also look at one that's a little bit more esoteric and not as commonly seen, but who's the actual accounting acquirer in the transaction? Sometimes, so legally, the SPAC is the acquirer, no question, right? But from an accounting standpoint, occasionally the target is the acquirer from an accounting standpoint. So the rules get really squirrely. And I think this is what sort of tripped up the SEC back in March, as they started to look at this and say, we don't necessarily agree with the way things have been evaluated historically, right? So I'm not saying anybody's right. I'm not saying anybody's wrong. I don't think anybody did anything nefariously or anything like that under the advice of Crow's legal in-house counsel. I'm making these comments. But I think what happened is, they reassessed and then they pushed back on some of these accounting firms and they said, yeah, no, we can actually see that perspective. We can see this position. There is a lot of gray space accounting here. And so individual, as Adele said, individual facts and circumstances have to be examined to drive each of these transactions in the proper account.
Can I ask a follow-up question on that?
Yes,
to Christy and Adele's point, if they're fractional warrants and they're de minimis, why even have them in the transaction in the first place? What's the attractiveness?
So when the whole warrant liability accounting came about, a lot of people were asking themselves that, do we switch to a right? Obviously the SPACs without any warrants, the warrantless SPACs, they certainly had a leg up. But at the same time, SPACs, which are cyclical, we're hitting a downturn, right? And it's really hard to sell a SPAC IPO at the same time, right? And so usually in those types of situations, you have to increase warrant coverage, throw maybe a couple other bells and whistles in there, maybe overfund the trust. things of that nature. So I think if a team could do a SPAC, a warrantless SPAC, they would. It's very hard to do right now though, except for only like the elitist of elite teams, right? You're just not gonna be able to do it. Having said that, some teams, I do know they were considering rights, but rights have their own issues too. So,
so this is just an icing on the cake for whoever wants to invest in the SPAC. Is that the way to kind of think about it?
Good way to look at it.
yeah, I mean, if you think about it, like you're asking someone to invest in a blank check, right? Like there's no operating company. You're asking them to put your money to work for potentially 24 months, right? And you're only getting a share. Like you're going to have to get something else for it. The only teams that can kind of get away with just a share are the ones where, it used to be just the biotech SPACs, right? Where they were sort of clubby, they were like a very devoted following of a number of investors, and they didn't necessarily care about warrants. And they also sort of knew that they were probably going to do a deal pretty quick. And so those are the only teams that can kind of get away with it. But if you're asking someone to park their money, especially in a low interest rate environment where there's no interest being earned on the trust, it's really difficult.
There's a lot of money to be made in this whole arbitraging and trading also between the stock and the warrants and things like that. And I do a lot of convertible debt of like lower tier companies, and there's often incentive warrants and other kinds of things. It's all like bells and whistles and cookies to get people to commit capital and get going for these companies. So it's a very important tool financially.
I can guarantee you that these warrants are arbitrage. I've been in the arbitrage space, in the volatility space. The difficulty is often finding the borrow, because it's not because you just have a warrant that is expensive, that A, the volatility is too rich, and two, you need to borrow the stock against it if you buy the warrants. It's not always obvious.
But circling back maybe to Alex's original question is, does any of this warrant accounting make sense from a materiality standpoint? Because as I think a lot of us have seen, a lot of these restatements, like they went through all this sound and fury, and the ending change to the financial statements was really small dollars.
Yeah, but it doesn't matter though, because if the SEC
doesn't matter.
The SEC says this is what we're doing, and frankly, some of the big accounting firms agree with them. You have to look at each deal and each instrument. But if that's what they want, they're getting it. So you gotta restate and get going and not stew in this. But there's a lot of big SPACs actually that are sidelined because they're not 34 Act compliant, and they're often offered by big financial institutions. You'd be shocked. So you can go on the NASDAQ list and see who is not current in the 34 Act filings. And you might decide you want to go in and scoop that up or invest in some way or help them, get them a new CFO. And you guys could be it because they missed this point. So there's a lot of opportunity here.
But also, what I would like to say is that, on the warrant warning was a warning from the Security and Exchange Commission that actually legally doesn't have any kind of binding effect. So then that is the fact why I say that there is a self-regulation in SPACs, because that is even a good example that even if that was not something legally binding for SPACs, because it was just a warning as a legal instrument, in the end, all the SPACs then they followed. And so this is something that soft law is even harder than hard law. So it's something interesting in the sense that the market is moving even with this, not binding instruments, because SPACs are informed by self-regulation. So actually, I think that the Security and Exchange Commission has to pay a lot of attention once they issue a warning or a statement, because especially in the US, they are very sensible SPACs to these changes, not in Europe. Like in Europe, for example, there was that public statement, even that is not legally binding, but didn't carry out problems in Europe, not like in the US. So the one point of concern in my view is that the Security and Exchange Commission has to start to pay a little bit of attention, even a little bit on SPACs, on how they treat SPACs, what they say to the market, because actually they move with the market. That is a SPAC actually.
Yeah, it's important to note too, to follow up on that, Danielle, is there have been a couple of SPACs that have just stuck with equity accounting. They've filed it, and so far they've gotten away with it, so they've adjusted some of the legal language, and Del could probably talk to that too, in order to sort of get around the liability accounting issue. But so you're right, it's not required, but like when the SEC makes a statement, like, everybody kind of
Exactly.
should probably comply.
What you say? My message should be like that. They should be a little bit more careful. I mean,
Yeah.
And to Adele's point, whatever the SEC says, they have a way of getting that. So whether it may not be today, but in 6 months' time, you may have a review done on your financials, and then you'll get a hefty penalty behind it. So,
well, think about it this way, Nilesh, right? Is the PCAOB is going to come in and select for sample audit, Ernst & Young's audit of a SPAC and say, well, wait a minute, looks like you're not compliant with the SEC's guidance on this. So that's kind of where this downward pressure comes. It's just a series of dominoes. And I'm not saying Ernst & Young is bad. I'm just using them as an example, please.
Right.
Yeah. Okay.
Yeah, I have a question on the valuations. Sorry, Mark, I'm sitting by the lake. I can't get my camera going. This may be a question for Christopher. See, I do valuations for privately owned enterprises, okay? So we follow either the ASA or the NACVA rules, and don't want to get too much into the technicalities of it. But if in case you're looking at the valuation of a SPAC, it's almost like doing valuation on steroids because they have access to huge resources. That's the starting point. And valuation is by and large based on the future benefit stream. It's not based on the historicals. So in your experience, how do valuators go about looking at these kind of specs, and how do they come up with the valuation?
How do they come up with the valuation? Oh, that's a great question. So again, this is me speaking on behalf of just myself based on my own personal experiences. And it's squishy, right? So generally what they'll do, and this is, valuation firms are good, right? They're really good at what they do, and I don't want to take anything away from them, right? But they'll run, they're going to try to run probably like a series of different models, and they're going to select, they'll try to get like a basket of securities, publicly traded stocks that are similar in some way to kind of get a group beta that should be applied to this company that's not currently publicly traded if it's a target, et cetera, and they'll come up with a good valuation number. What they'll probably should do, or like if they wanted to value the warrants of a SPAC, is run a series of Monte Carlo simulations. That'll get the auditors happy. They also like to see like binomial lattice model run again at the same time as a Monte Carlo to kind of get two perspectives or two data points that they can compare and contrast to kind of drive this, right? Now, I'm quite more practical than this. So, I have my degree from the University of Chicago, my MBA in finance, of course, but also in econometrics and statistics. So I understand how to build binomial lattice models and all that sort of thing. And most of the time, I can get pretty darn close to whatever valuation they're going to give me by picking a good Black-Scholes set of inputs. I hate to say it that way, and I'm not saying that will not pass audit, folks, right? Like your auditors will throw up all over a Black-Scholes valuation on these complex financial instruments, but as a good gut check, like, are you getting close to what you need to be getting to? If you can throw together a decent Black-Scholes with good assumptions, you're probably going to get there. And the thing I have, right, as Christy was saying earlier, it's hard to value SPACs because there's these warrants, there's all these other features. You don't know how these investors are going to treat things, blah, 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 right? One thing you can say for sure is, the investors are going to try to maximize their own personal returns, their own personal utilities, and they might get it wrong from time to time. And the binomial models and the Monte Carlo simulations are built to capture all of those little nuances of where people make a bad decision and so forth. But frankly, I think, if you approach it from a perspective where you say, look, what's likely to happen here? What's most people going to do? How are they going to treat these things? And almost always it's going to be a hold strategy, right? Except for the arbitrage players out there, these investors, especially in the IPO rounds, they're probably trying to hold on to see what's going to happen, right? They want to do a DraftKings. They want to be part of the next DraftKings, so to speak. And so I think you value along kind of like those lines, and you can, for your own edification, you can ballpark where you think the valuation should be. Now, that said, your auditor will not accept that. They will not. So you need to get a formal valuation report done by a reputable firm with experienced people that your auditor looks at and says, yeah, we can rely on this. But I think to Alex's point earlier, you do all this sound and fury and you come out with an answer that's kind of really immaterially different from what I threw together or quickly on a Black-Scholes sketch. But that's just my own personal perspective.
Yes, there's a follow-up question. How about the COSO framework, the COSO readiness, internal controls, the corporate governance, and the whole, structure of, readiness for 404 certification or 302 and so on and so forth. I'm pretty sure they all will have a bearing on the valuation, don't you think?
Sarbanes-Oxley will not impact the valuation. So the valuation firm, at least that I've never seen it, where a valuation firm has considered the strength of internal controls and financial disclosure controls. Sarbanes-Oxley comes into play, particularly with a lot of the SPACs that had to do the restatements based on the SEC's advice, where they had to go back and they had to file material weaknesses, right? Because basically you have two assets on your balance sheet. You got cash and you've got equity, and you messed up equity, right? So that's a material weakness. Now I'm oversimplifying a lot, but if it's a SPAC that hasn't de-SPACed in any way, then that's pretty much what you got. So they had to file material weaknesses and do all the restatements and throw themselves on the tender mercies of the investor class, right? But honestly, I think there's not a lot of weight that was placed by the investor class on those material weaknesses because they're smart investors. That these people, most of them are very smart investors, and they get it, right? So, but anyway, that's the only thing that SOX has to say. I would not say. I would ask my other panelists: has anybody ever seen a Sarbanes-Oxley type of an internal controls perspective of impact evaluation? No, I don't think so.
I have a quick question on valuation. I'm involved as a strategic advisor to a SPAC, and especially on a cross-border transactions, many of these targets actually are going IPO instead of using the SPAC method. When you compare the valuation, whether it's PE, price to book or price to sales, what does a valuation look like from IPO perspective versus the SPAC? Is one discounted over the others, and what would the reasons be?
So I'll take that. The main difference with going the traditional IPO route versus a SPAC route, and this is going to be a little bit, bear with me. So think about a traditional IPO process, right? It's like a 6 to 9 month process. You got to put together, your S1 registration statement. You've then got to go on the roadshow, meet with investors. You still have no idea what your valuation is, right? Like your bankers are telling you one thing, you really don't know until you meet with investors and they give feedback. And then the bankers attempt to price it. They usually price it poorly, right? And it usually rises 20, 50%, day of IPO. The difference with a SPAC, right, is everything is done privately, right? So what you'll do is you'll negotiate with the SPAC. It hasn't been announced to the public yet, right? And so nobody knows. You're then probably meeting with PIPE investors who are really going to do the work as far as telling you what your valuation is. And it's similar to a traditional IPO process, right? Which you'd probably be meeting with the same investors if you were going the traditional IPO route. And they're going to tell you what your valuation is. And they're going to say, I will invest at this valuation. The difference is you as a company, if you don't like the valuation with a SPAC, like you don't have to do the deal and nobody's the wiser. And so like, I kind of always use this example, like someone had asked me on something else about the WeWork transaction, right? If you remember back in 2019, they tried to do the S1, they dropped their S1, everybody tore through it and was like, this is ridiculous, they thought the range was just way overvalued. And now, WeWork had egg on his face, right? If WeWork had gone through that process with a SPAC, nobody would have had to know. Like the PIPE investors would have said the same thing. They would have said, your valuation is this, we're not investing. And maybe at that point, like, WeWork walked away and like figured something else out, but the point being, it's a similar process. It's just how you get there is different.
What's the roles of the pipes and that are contributing to the recent slowdown in SPACs?
I'm sorry, I didn't hear your first part, Mark.
No worries. With regard to pipe, what is the role of pipes, and are they contributing to the recent slowdown in SPACs?
They're not, well, so pipes, they provide a nice validation of the valuation, right? And so think about it, without a pipe investor, it would just be a negotiation between the SPAC and the company, right? And both sides are particularly motivated for their own reasons, not necessarily on the side of the public investor, right? The pipe investor is, right? And they're supposedly, you know, smart money. They do extensive due diligence usually on these deals. And so they're the ones that come in, and if you have top tier pipe investors in your pipe when it is announced, like you've got Fidelity or you've got Wellington, you know, and they're coming out and they're saying, we want in on this deal, it's a stamp of credibility. And it's important. Now, not all pipes are the same. Sometimes you have a backstop pipe, right? Which is sort of like the pipe of last resort, that is backstopping the trust in the event of redemptions. And so you kind of have to look at each pipe with the lens of who's participating and in what capacity.
Thank you. Any other panelists want to chime in on that, or go to the next question? What are the key negotiated issues between a SPAC and a target company? Adele?
Yeah, so it's basically, you know, an M&A thing, an M&A deal. The target is going to want to look for certainty of execution, what their deal is going to be in terms of management. You know, are they staying on to run it? You know, how's that going to work out? Obviously holdbacks, obviously companies that are selling like to strip out cash or possibly other assets like IP, et cetera. It's a very typical M&A negotiation, I think, but maybe others have other experiences. Just sometimes you have to explain the whole SPAC thing. You have to explain the pipe situation, which you have to explain backstops, because sometimes the pipes themselves have a backstop. One of the key investors might agree to step up if there's a lot of redemptions, as Christy mentioned, but some of those backstops are not as binding as others. These deals are not as cookie cutter as you think. And I just ran a program, a 2-day program on securities and M&A for PLI, and basically the M&A panel, we all said, like, really every SPAC deal is different. It's like a very typical M&A deal where each deal has its own unique negotiating points and features.
Yes, absolutely. I agree with Adele, and I think also I would like to add that from a target point of view, I would not go necessarily to the SPAC that has the biggest amount of cash, but like also especially looking at management. So to the SPAC sponsors.
The other two pointers I'd put out in case anyone here is a target is, first of all, don't limit yourself to SPACs that are just identified as in your area, because I have represented some SPACs that have gone outside their area. So they might be a bunch of, you know, oil and gas people, but they actually sometimes will buy in tech or electric vehicles or things, you know, fuel cells, things that are related but slightly outside. Mm-hmm. And then the other thing is I've just closed a whole bunch of M&A deals, and I'm in the process of some others, and a lot of them, the sellers are emphasizing their tech. And it may not be that sophisticated tech, but it's very attractive to buyers. So if you have a good website or users, or, you know, those kind of metrics that people look for these days and have for years, but if you have that, it can make a deal very successful, and it will go through often.
And what are some of the biggest surprises for management teams as they're going through a SPAC process? Chris, and then Adele.
Yeah, so the biggest surprise, I think, is how much work is involved. You know, so I think from the SPAC side of things, they get hit with a lot of things they hadn't thought about. You know, and not to pick on SPACs, right? But they tend they don't want to spend money, right? Because every dollar you spend is a dollar less to target investment. So they don't want to put a lot of money into building their own infrastructure, they're probably going to rely upon the target's infrastructure. And then from the target standpoint, it's like, oh crap, they're going to rely upon us to support this whole vehicle now as a public traded company. And we're private. We've been private all these years, and we don't have SOX built up. We don't have good IT infrastructure built up. And so there's a lot of surprises on either side. My biggest surprise as personally in dealing with these things is the craziness that you get when you talk to the auditors. So not to pick on my own profession, but hey guys, we're trying to figure this out ourselves, right? And everybody's trying to do the best they can with what limited time they have. And so there's a lot of mad scrambles. So, my recommendation is, build a plan. What is it? Build a plan, then work the plan, or whatever the thing is. So really have a good plan, get your auditors on board, get your investment people, get your advisors on board, your attorneys, please, and your valuation people, and work that calendar.
Adele.
Yeah, I would also say sometimes people balk at the sponsor piece of it because it's often 20%.
Yeah.
Also, sponsors don't realize, they have to put up, sometimes $8 million or something on a typical size SPAC. But a lot of times your bankers will bridge that, or they have somebody who really wants to be in SPACs, or a whole cadre of people. So don't panic about that. And, it's a real deal. I mean, the SEC is looking for the professionals to be sort of gatekeepers. And I know the banks have stepped up their screening process, because remember the Super 8K that comes after the vote, where you have to file your financial statements and everything, and you really do a fulsome disclosure, that comes sort of after the vote. But it has to be credible, and, you have to make sure you've got your pieces together, because it's due very quickly afterwards.
So you need to start prepping for that Super 8K well before the vote occurs.
Before. And what happens after the SPAC enters into an agreement with a target company, Christy?
I'm sorry, can you repeat the question?
What happens after the SPAC enters into an agreement with a target company usually?
Right. So, well, first it's usually an LOI, right? Usually it's a non-binding LOI, where, the SPAC may have a lot of non-binding LOIs as they're evaluating, which is their favorite, but usually it's been narrowed down to just one at that point. But then you sign a definitive agreement. You then announce it, right, to the public. But usually ahead of an announcement, you've already, you've engaged an IR firm. Like you've already sort of put in place like the procedures after the announcement, but then pretty quickly right after the announcement, and Adele can follow up on this, like you have to file a proxy for a shareholder vote, and that begins sort of like a 3 month or so clock, right, where you're submitting, where the SEC is providing comments on your proxy statement, and there's a couple of rounds of that go back and forth. Eventually, you narrow down those comments. And the SEC declares the proxy statement effective. But usually right ahead of that, you will have set the record date and the shareholder vote date. So from let's call it definitive agreement, usually it's pretty quick in order to sort of announce the deal to the public. But then from announcement to shareholder vote and quote unquote de-SPAC is about on average 3 months, give or take a month. Later. I've seen as quick as 2.5 months from IPO to de-SPAC, but that's pretty aggressive.
Interesting, thank you. Milos, what do you see as the differences between a de-SPAC versus an IPO, and what should management teams be thinking about? Well, we'll just leave it at that. What do you see as the key differences between a de-SPAC versus an IPO, Milos?
Yeah, I think a lot of this is covered by Adele and Christy.
Sure.
Simply, there are different companies. I would, academics would agree. IPOs means underpricing. Bankers do not price IPOs well. There is a lot of money left at the table. So a lot of these companies that maybe we can say SPACs are bringing to the market, most likely wouldn't do fairly well in the IPOs on average. So IPO for them is more expensive. They are able to get probably less cash, and I would say this is the major reason why a lot of these private companies go through SPAC instead of the standard IPO. Although this year was, I would say, good for IPOs as well.
Chris, what are the key accounting issues that arise in SPAC transactions? You're on mute.
Yeah, sorry, having trouble getting off mute. Key accounting issues, I think we've covered a lot of them right to this point, is the warrant issue is going to continue to be large. You've got to make sure you get that right. I think that sort of slowed down a lot of some of the SPACs that were occurring. I think companies have now gotten more comfortable with how the accounting needs to be worked and the estimates that need to be made. So that's probably no longer a real speed bump. But getting valuations done, right? I know we've got some valuation professionals on this firm on this call right now, getting good valuation numbers. I almost want to kind of put those guys on retainer, frankly, and involve them at various points to get things like the founder shares valued or the overall enterprise value for the target. The target probably has, you know, preferred shares, or they've got some kind of goofy convertible preferred debt or something like convertible debt, excuse me. And all these things will need to probably be valued independently and in the whole. So getting ahead of a lot of those accounting issues can be really, really hairy, but you want to make sure that that's an early thought.
Christy, where do you think we are in the SPAC cycle, and what do you see happening over the next couple of years?
It's a good question, right? It's the question on a lot of people's mind right now. Where are we in the cycle? You know, as we sort of mentioned earlier, there is the cyclicality to SPACs. With every wave of new issuance, there is a corresponding pullback. We had started to see that pullback in starting technically end of March, but mostly April it started. And we would have thought we'd have come out of it by now, but there's a lot of extra noise out there. You know, I mean, you've got Delta, the Delta variant, you know, you've got concerns about the economy. Traditional IPOs are saturated, SPACs are saturated, you know, we raised a record amount of money. And so I personally think that it's going to be prolonged. I initially, if you had asked me this back in early June, I think I was saying, like, I didn't really expect the market to recover until after Labor Day. But at least we would have been on like an upswing at that point, like heading into it. I don't think that's the case. And the bigger problem too is, you know, Q4 for SPACs is traditionally never a good quarter. Usually you have a lot of investors sort of protecting P&L, not really willing to sort of risk that. And so it becomes generally a difficult quarter. And so if the current sort of down cycle sort of dribbles into that, it could be just a really challenging second half of the year. Having said that, you know, it never rains forever. The sun eventually does come out, you know, and it may be, we're looking at, you know, January. It's really too hard to tell right now, though, honestly. There's so many variables that it's really difficult.
But the thing, because of these, you know, generally 2-year timelines, that doesn't mean there couldn't be a lot of both job opportunities and consulting opportunities and deal opportunities, because there's going to be a lot of diligence and things going on as people look for different M&A opportunities. Otherwise, you have to give the money back. So they're really going to be seriously looking at a lot of companies, and even consulting on deal teams, looking at companies could be very interesting and gets you in the SPAC market if you're so inclined.
Perfect, excellent. And we'll be wrapping up. And so, folks, if you have to leave, that's fine. I'm going to ask the panelists each one final question, and then anyone who wants to stay to do some networking. Again, I know how difficult it is to network during COVID, and so I'll leave the room open so that folks can just kind of say their background, what it is they're offering, and then also what they're looking for. So, Christy, finally, what's coming up for SPAC Insider? What can we expect from you, going forward?
A couple things, I got a couple irons in the fire. Not really anything I can kind of like talk about just yet, but as for everything else, more of the usual, just covering the space, providing as accurate data as possible. I will say though, I do have to hop because we have a number of IPOs tonight, and so I do have to run, and I hate to cut myself short here, but I want to thank you, Mark, and everybody else on the panel, and looking forward to talking to everybody soon. So thank you.
Thanks. Thank you very much, and folks, feel free to register for SPAC Insider. I'm sure you all know the website now. So same question to you, Adele. What's new? What's coming up for you in the next few months and so?
I think it's going to be a very busy M&A year, honestly. It's already been a very big year just with regular M&A as well as these things. And also the thing I was talking about earlier, which is these investments in smaller companies as a cheaper alternative to a SPAC. I've seen a lot of activity in that, a lot of activity.
Excellent. Chris, yourself?
Yeah, thank you, Mark. Boy, I'm all similar to Adele. I'm looking at a pretty steep mountain to climb getting into the holiday season, right, when things will hopefully slow down a little bit. But one of the things that I've been doing just kind of as a point of passion is I've been getting more and more involved with robotics. I'm doing software robots and finding ways to deploy those at my clients and save time and money and improve speed and accuracy. So it's completely non-SPAC related, but maybe I'll start a SPAC or I'll start a company someday that'll be a SPAC target that does robotics.
Perfect. Milos, what's coming up for you?
New academic year. I hope that I would get out public few more SPAC papers, and hopefully I get some little bit more consulting on SPACs in terms of valuation and some other phases where I could help. And thank you, Mark, for assembling us here tonight.
Wonderful. Yeah, thank you all for assembling at such short notice. I really appreciate that. And finally, last but not least, Dr. Daniel, what's coming up for you? I know you have a book coming out, so.
Exactly, that is one of the things. So even looking for a book launch very soon, and then we are advising a SPAC consultancy, a UK company that is looking for an IPO through a SPAC in Italy. So this is something that we are assisting that actually, there is, especially in Italy, maybe something that didn't come up in this conference, but now today, the minimum amount to be raised as a SPAC in Italy is 10 million. So like this is like a sort of micro SPAC model that different companies are looking at. So to raise not a lot of money, like from 10 million up to 50 million on the market. That is something that, for example, today in London, you cannot anymore, because in London now the limit is minimum is 100 million. And the thing that I would like to say in general is that I think, and this is, I think, the message for everyone, that SPACs are a great American innovation, and we have to be thankful. The world has to be thankful to America for this. And I hope that in the next months and years, the Security and Exchange Commission and even the Congress will understand, as they are already doing, the importance of SPACs. So the fact that, we should not underestimate how these investment vehicles, they have transformed the world. And if this happened, SPACs, one thing that I even wrote on Fortune is that SPACs, they believe in dreams, in the dreams of people and businessmen. And so this is what America is for. To be great in America is to become a businessman. So SPACs are giving this kind of hope and this possibility. So this is my final message, actually, to be pro-SPAC.
Excellent. Thank you for that. And my name is Mark Hamzat Arabogbo. I'm chairman of the Capital Markets Special Interest Group. Thank you for joining us for the State of SPAC Capital Markets. Like I said, this is the thing. So I'm going to leave the room open. I'm going to stop recording. I'm going to leave the room open for folks to go ahead and introduce themselves. Actually, one of our sponsors is here, Alan Thornton. If you want to go ahead and start, and then folks just kind of introduce yourself. 20 seconds, 10 seconds. Tell us what you do, what services you provide, how you can help people in the audience, and share your information in the chat so we can do a little bit of networking. It is difficult to do it during COVID, and we want to try and help folks do as much of that. So go ahead, Alan.
Thanks for setting this up, Mark, and thank you to all the speakers.
Thank you. Thank you very much. All of the speakers.
Real quick, I am one of the sponsors. My name is Alan Thornton. I'm the CEO of Money for Your Mission, Inc. And what we do is we help SPACs create social impact through ESG initiatives and also diversity and inclusion, increasing their overall valuation when they hit the market. So that's what we do. Pleasure to be here and to be in front of such an eloquent group of people. So thank you, Mark, for putting this together.
Super.